Okay, continuing on. Let's say we don't want to take a passive approach, but a more active approach. How do we define our discretionary deviations? Well, we can do a variety of methods to try and define where these are. We're going to talk about 4 here. So we're going to talk about economic fundamentals as one method, using technical rules. Third, we'll talk about the carry trade, and then we'll talk about volatility trading. So these tactical deviations, they require the manager to have views, right? This is why we're active traders, because we have views. We think things are mispriced, and so we can take advantage of those mispricing. We have 4 versions here. No one approach works more consistently than the other, so that's why we're going to talk about all 4 of them. So if we start with economic fundamentals, okay, so the idea here is that long-term currency values are determined by purchasing power parity, and short-term deviations can be exploited. So when I mentioned purchasing power parity in an earlier module, I mentioned that, yeah, this is a long-run phenomenon. It doesn't seem to hold very well in the short run. And so just as a quick reminder of this, right, if I have 2 currencies and one currency is expected, or one market's expected to have 10% inflation, the other one is expected to have 2% inflation. Well, PPP just predicts that that one currency should decline in value by 8% relative to the other one based on the differential in inflation rates, 10 minus 2. Okay, that may hold generally in the long run. However, in the short run, it does not seem to hold. So short run deviations from purchasing power parity are perhaps opportunities that can be exploited. So these short-term increases are associated with a wide variety of things. So, for example, greater undervaluation relative to long-term value. So maybe it is reverting to the mean, reverting back to purchasing power parity. It's just taking its own sweet time in doing it. A faster rate of increase in long-term value. So maybe in that economy, estimates of G, the growth rate in that economy and that market, have changed, and so that's affected the currency, the exchange rate. Maybe lower relative inflation than was once originally expected. So that's going to change the calculus of the purchasing power parity. Higher real and nominal interest rates certainly going to play a result here, or certainly play a factor in the result here. And then finally, a decreasing currency risk premium. All of these things that can have are things that can have short-run effects that perhaps present us with trading opportunities that we can exploit for a little bit of extra alpha. Long run, we sort of expect things to revert towards, at least, purchasing power parity. Okay, number 2 is technical rules. Past price action predicts future price movement. Right there, we've just violated the weak form of the efficient markets hypothesis, right? Past price movements predicting future price movements. And so that is a violation of the weak form of the EMH, but we do have a fair amount of evidence that shows that is true in currency markets. So some phenomenon that we've seen, overbought and oversold markets do tend to mean revert. Prices tend to reverse at support or resistance level. So if they're bumping up against a resistance level, they tend to bounce back down. If they're coming down to a support level, they tend to bounce back up, unless there's a breakout. They pierce that level, in which case they tend to keep going in that direction. Well, there's some art here as well as whatever science is here. Not easy to make money doing this because either one of those things can happen at any time. But we do see some past pricing patterns resulting in future price movements. And so another thing that we can look at here are moving averages. So if I have a shorter term moving average moving above a longer term moving average, well, that's a signal that prices are going to continue to rise. And if we reverse that, they're going to continue to fall. So technical trading rules, technical analysis does seem to have a home and play a role here in currency markets. As the old saying goes, you don't need to know what the currency is worth, you just need to know where it's going to trade at.